Well, good afternoon. My name is Anthony Virtue from Bell Asset Management, and I'm here today with Ned Bell, CIO. Thank you very much for joining us at our webinar. Before we get started, just a reminder that this webinar is for information purposes only and does not take into consideration the investment objectives, financial circumstances or needs of any particular recipient. It contains general information only. Before making any decision in relation to the funds, you should consider your needs and objectives, consult with a licensed financial advisor and obtain a copy of the PDFs. Today, Ned will be discussing global, small and mid caps. He'll outline the argument for why you should consider an allocation, how this may complement other growth sleeves in portfolios, and what the opportunities are for investing into the global SMID sector in the current market environment. You'll notice there's a Q&A section at the bottom of your screen where you can type in questions. This is a great opportunity to ask Ned anything that you like about the global small and mid-cap sector, so I encourage you to do so, and we'll certainly endeavour to answer the questions at the end of the presentation. Firstly, just a really quick refresher on Bell Asset Management. We're now managing over $2.4 billion in FUM. Importantly, we've been managing global equities now for over 16 years. So we have extensive experience in managing portfolios in a whole range of market conditions. Importantly, over this same period of time, we've also been investing in and researching global small and mid-cap companies. And we've long advocated for investors to consider an allocation to this sector to complement and diversify existing global exposure and to take advantage of their excellent growth prospects. I'll now hand you over to Ned, who'll take you through the case for investing into global small and mid-caps. Thanks, Ned.
Thanks very much, Anthony, and thank you to everyone who's joined the webinar today. So, as Anthony mentioned, the purpose of the webinar is to really make a strong argument for an allocation of global small mid-cap stocks. In our view, this is one of the most interesting, exciting and opportunistic sleeves within global equities that investors have very little exposure to, but should seriously consider making an allocation to. And really the case is laid out in this page 5. The way we think about it, it's a growth option. It's a growth alternative within the global equity universe. That's the role that it plays. It avoids a lot of the risks that come with other growth sleeves. So if you think about large cap growth, there's far less valuation risk in SMIDs than large cap growth, less absolute risk than emerging markets, which, as we all know, are extremely volatile, and especially heading into what's obviously been a difficult trade war. And there's less liquidity risk than small cap stocks, and that was evident in Q4 last year when the market fell very heavily. A lot of the liquid small caps were hit particularly hard. From a diversification perspective, we think that an allocation to SMID complements other parts of portfolios extremely well. The types of companies tend to look very different to large cap growth companies. For example, there's far less tech exposure. The performance of the asset class, when we think about making an allocation to an asset class, it all comes down to the scoreboard. The performance has been brilliant. It has been very, very strong. Over 20 years, an allocation to global SMID has given you a return of almost 300%, which is more than double that of the MSCI World Index, yet people have very few allocations to the asset class. From a fundamental perspective, the actual revenue and earnings performance of the asset class has been very, very good. And then number 6 on this slide, we all often think about where companies are in their business cycle, and they really are in a sweet spot in that they are at a point where they are they're getting into a growth phase of their business. They're financially very sound. They're generating strong cash, but unlike large cap stocks, they've got a long runway of growth ahead of them. So the organic growth that you find in small mid caps is generally very, very good. And especially as we're heading into a period of economic weakness, finding that organic growth, the large cap end will be harder and harder. Hence, the more reason you should be looking at small mid caps. From a valuation perspective, we also think they are very, very attractively priced at the moment. Unlike other growth sleeves, where especially large cap growth, which is very, very expensive, we tend to find the valuations in small mid caps are pretty attractive. They have lagged in the last couple of years for reasons I'll get into, but the result of that is that the forward-looking PE is a bit under 17 times now, which is effectively in line with their 5-year average, but much, much cheaper than the large cap cohort, where many investors tend to be crowded in those large tech stocks that we all know well. So getting into the performance track record of global SMID cap, again, I think looking at the actual scoreboard is always a good reference point when assessing a new asset class. What this chart shows on page 7, it compares the MSCI World SMID Cap Index as a proxy for small mid-cap companies in the context of cumulative returns versus standard deviation. So in other words, the risk-adjusted returns. And the point to make here is, first of all, as I said before, the performance has been very good and it's outperformed all of those other buckets, if you like, within the global equity universe. It's done a lot better than large cap growth over a long period of time. Yes, you've had to take on a little bit more risk, but you've been very, very handsomely rewarded for taking on that risk. And so I think that's a useful reference point when you're thinking about this as an allocation. This slide shows how the various asset classes look on a mix of upside capture on the left and downside capture below. And so ideally, you're looking at upside capture meaning above 100, it means that in up markets you are outperforming, and in down markets, if it's below 100, you're also outperforming. So MSCI World SMID Cap has done very well in those stronger markets. The downside capture has been okay, but it's been much better than the MSCI World Growth Index. So in other words, when markets fall, they've actually held up pretty well. And that surprises some people, that the stocks have actually held up pretty well when markets fall. On a looking forward basis, I think that is still a very strong argument, because what's changed in the last 5 years, again, is the fact that there is so much crowding in these mega cap growth stocks. They are so well owned that when markets tend to have drawdowns, they tend to be led by these mega cap stocks. And again, we saw that in Q4. So that's just, those two charts are meant to give you just a little bit of perspective around the asset class. But I think the one thing I'll leave you with is that it has performed extremely well over a number of years. The next couple of charts looks at how the asset class does in very strong and very weak calendar years. So this chart, page 9, we wanted to look at the negative calendar years for the MSCI ACWI index on the left-hand side, sorted from the worst down to 2015, where there's a slight negative return, and then look at how MSCI World SMID did in those markets. And I mean, obviously, yes, the MSCI World SMID was weak, down by 14.1% on average, but it actually held up reasonably well versus, on the left-hand side, you can see MSCI World Growth, so those large cap growth stocks, they didn't fall as much. And then on the right-hand side, I've really tried to identify what I would call the really high beta growth sleeves, meaning like MSCI World Emerging Markets, MSCI Emerging Small Caps, and Aussie Small Caps. And those three high beta growth sleeves on the right-hand side, they got hit very, very hard in those weak markets. On average, they were down by about 20% in those negative markets versus MSCI World SMID being negative 14. So that's just a bit of a stress test to see how the asset class does in weak markets. And the next chart then is the complete opposite, looking at the stronger market periods. On the left-hand side, you can see the strong calendar years according to MSCI ACWI, and then looking at how MSCI World SMID did. So again, in that upmarket type environment, as an asset class, performed very well. The average return being 21.5% versus ACWI 18, MSCI World Growth at 17. Against the high beta growth sleeves on the right, no, it didn't keep up, and frankly, you wouldn't expect it to. It's not necessarily a high beta growth sleeve, but that's okay. But the point I'd make is that against the MSCI World Index and ACWI, it's actually performs very, very, very well. So it's a bit of a it's an asset class that does well in all market conditions. when investors often look at asset classes, they often look at, again, it's the risk-adjusted return. So we want to look at the Sharpe ratio of the MSCI World SMID versus some of those other growth sleeves. And so this is looking at just it's looking at the return divided by the risk. And you can see there that basically, with a Sharpe ratio of 0.83, it's a very high risk-adjusted return for the asset class, especially considered when compared to those high beta growth sleeves around 0.35 to 0.4. So you're effectively getting twice the level of return per unit of risk by investing in SMID, which is very, very compelling. In terms of the recent returns, and I think this is really interesting. Now, this is to June, so it's a few months out of date, but I think the case is still there. The MSCI World SMIDs have actually lagged a bit in the last couple of years. So as much as they've been very, very strong performers over a 20-year period, they haven't quite kept up in the last 3 years and the last 5 years. But I think that therein lies the opportunity for investors looking for an opportunity now, because when we have conversations with investors now, it always comes back to where would you be putting new money right now, especially in the context of where growth stocks are. They're very expensive, they're very crowded. Emerging markets, the earnings risk is much more elevated now than it probably was 12 months ago for a number of reasons, but one of them being the trade war. Here, you're finding an asset class that consists of very high quality companies that have lagged a little bit, almost by virtue of the fact of just their size more than anything else. And as I said before, the valuations are attractive. So you can buy a long-term winner that's temporarily a little bit out of favour. So the opportunity is fantastic. The next part of the presentation, I want to get into a bit of what I call a global small mid-cap drill down. So this is, what I want to do is just to give you a bit more colour. So this asset class is not that well known to most investors. So I want to give you just some broad strokes in terms of how to think about it. So this chart really just breaks down the MSCI World Index by large, mid and small using the MSCI definition. So the way to think about it is global equities, the top 72% of the MSCI World Index is generally considered large cap. Mid cap, the next 14%, small cap, the next 14%. Now, if you think about a lot of global equity portfolios in this context, I think it's probably fair to say most of them are very, very heavily skewed towards that large cap segment, and possibly with a hint of small cap at the bottom. But more often than not, very little, if any, exposure to mid cap, and probably not enough exposure to small cap. So I think that's a useful just reference point. So then when you think about, this next slide just shows what does the actual small mid-cap or mid-cap universe consist of. The bottom 28% of the MSCI World Index, there's a bit over 5,000 constituents with an average market cap of about $2.5 billion, going all the way up to $26 billion. So unlike Australian equities, the definition of small cap and small mid-cap is quite different. There's a very big investable universe. There's a good degree or range of size of companies. So the opportunity set is huge. And speaking as a fundamental investor, the bigger the opportunity set, the better. So we find an abundance of opportunities. Again, that's quite different, we would argue, to the Aussie market, where there's a real shortage of interesting opportunities in the small mid-cap space, especially when you overlay with valuation. So those two slides are meant to just give you a little bit more context around the types of companies that you're looking at. Page 15 this is really referring to the comment I made before about thinking about companies in their life cycle. So if you think about, again, like many global equity portfolios in this context, you'll probably find that the bulk of your portfolio is at the far right of the chart, whereby they are either in maturity or they're approaching maturity. And if you're in the value cohort, you're quite possibly in decline. So having your portfolio heavily skewed towards the right-hand side of this chart doesn't make too much sense. On the far left-hand side, we typically find small cap stocks. That's where you typically find businesses that are going through the fastest part of their growth trajectory, but they're not financially sound as they could be. The way we tend to think about small mid cap, it's that range it's in that growth range where the sales growth is accelerating, coinciding with a period where cash generation and profit generation are also accelerating. And that's really the holy trinity. It's getting those three accelerating simultaneously. That's how you should think about an allocation to SMID. That is the ultimate way of getting exposure to companies at the best point in their cycle. And the only way we think you can do it is by making an allocation to SMID. Just again, this is a context chart, thinking about, just reminding you about, okay, so what do the largest companies in the world look like? These are the 10 largest constituents of the MSCI World Large Cap Index. And as we know, you'd all know these names, but as we know, I mean, these are the stocks that have driven global equities for at least the last 5 years. On average, they've generated a return of about 145%. They've been the one and only driver, and as a result of that, a lot of the SMID cap stocks, they have been left behind somewhat. The other trend that has been very noticeable in the industry over the last few years has been the growth of ETFs and various forms of passive ownership. And what you can see here is that if you look at the ETF ownership of those names from 2014 to now, it's 12.5% on average. That means 12.5% on average of the register of each of those companies is owned by ETFs. And that's now moved to 19.2. And on average, they're held in over 200 ETFs each. So the point I'm trying to make is that, and that's a whole bunch of different types of ETFs investing in those companies, but I guess the point to make is that momentum as a factor, as it relates to these stocks, has grown instrumentally over the last couple of years. And Q4, again, was arguably the first little snapshot of what happens when negative flows hit markets. You actually see a lot of profit taking in these very large companies, and a lot of it does relate to ETFs. And while Q4 was a short window into what can happen, there is a possibility that we see that again, possibly next year. And as this point relates to small mid cap, we would make the point that they're far less vulnerable to these types of outflows. Again, this is a perspective slide. We're trying to give you an idea about the size of the types of companies that you'll see in MSCI World Large Cap in the top left there. Again, these companies are enormous. They're absolutely huge. The top 10 are over 300 billion in market cap each. On the far right there, you can see the MSCI World Small Cap Index, bigger than Aussie companies, but still liquidity is somewhat problematic, even at the high end there. So the top 10 stocks in that sort of 8.9 to 10.3 billion range. And then Aussie small caps at the bottom right, far less liquidity, but far less liquidity and, an upper limit of about 5 billion. But then bottom left, again, coming back to the MSCI World Small Mid Cap Index, they occupy a very neat little space, which is basically above small caps, but there's enough liquidity there. So we're talking about companies that go up to about 26 billion in this case, all the way up from 1 billion or so. So it's a much bigger addressable market from an opportunity set perspective. And then drilling down into, so this is looking at the largest index holdings by sector. So if you look at the sector, the asset class from a sector perspective, again, it's quite different. It's not all about tech. Industrials at the top left there, about 18% of the index. Financials, IT, consumer discretionary, healthcare, real estate, they're all similar weighted sectors. So I think there's a good balance within the subset. And then if you look at the companies here, you won't recognise all of them, but you'll probably recognise some of them. And I think that's a bit different to the small cap cohort, where many investors just do not recognise any of the names at all. And you tend to find a lot more obscure type companies who have probably got a bit more, they're not quite as financially sound. So, in the financial space, you can see companies like London Stock Exchange, which was recently bid for by Hong Kong Exchanges Group, which hasn't gone through, but nonetheless, it's obviously a well-known company. MSCI, we've been a long-suffering customer of MSCI, so can attest to their business model being extremely profitable over the years. In the tech space, they tend to be specialist type companies there, each with quite interesting niches, but again, not necessarily as correlated to the large cap competitors. In the consumer discretionary space, again, you'll recognise some of those names there: Ferrari, Lululemon, Chipotle. These are all brands that are well known, especially in the US, and they have good, strong franchises and tend to generate good profitability. From a healthcare perspective, again, we're not talking about large cap pharma. These are really interesting healthcare companies that have got unique franchises in really interesting subsegments of the market. And then real estate, you might recognise a few of those names. CBRE is obviously one that sticks out. So that's just to give you a little bit of colour about the types of companies you'll find in this subset. Again, as a fundamental manager, we put this chart up to give you just, again, a bit of perspective about, from our view, about what sort of companies get through some basic filters from a fundamental perspective. And so here we started at the top by saying, okay, look at all these companies with a market cap of up to 28 billion and apply various filters relating to liquidity, revenue growth, profitability growth, margins, decent leverage, and decent return on capital, etc. And so these are pretty high barriers. And the point we'd make is that even like running that 4,600 companies through those hurdles, you still end up with about 145 companies. So the investable universe is pretty good. So there's a large degree of depth there. Again, if you compare it to the Aussie small cap market, it just could not be more different. There are so many more opportunities to invest in. And then when you break it down by geography and by sector, again, it's quite diverse. You'll see that you've got a broad mix there between North America, Asia Pac, and Europe. And then from a sector perspective, you can see again there's decent diversification across industrials, IT, healthcare being sort of the dominant ones, but also discretionary and financials. So it's not a one sector, one trick pony. It's a really diverse level of companies. And then this chart, page 20, we want to give you some perspective around if you take those 45 companies and you run them through a couple of different earnings filters, what types of companies come out the other end. So if you start with the left, the return on, so let's see how many of those companies have got a return on capital of 20%. Now that's a very high bar. Like that's companies that generate a return on capital above 20%, they're doing something right. And the point we'd make, 100 of those, 145 companies are generating 20% return on capital, which is pretty good. It's pretty impressive. Companies like Rightmove, we own that now. We've owned Rationale until recently. We've sold that for valuation reasons. But these are all companies that generate really, really strong returns and reside in the mid-cap universe. From a margin perspective, companies like Partners, Griffin Checkpoint, Arista, and Align now, all holdings in our portfolios. So really, really interesting companies that are generating great margins. And then really importantly from a growth perspective, again, this is a growth asset class. There's 103 of those companies that generate a 5% sales CAGR north of 10%. Broadridge, another holding. Montclair we've just bought recently. Genmab, we've owned. We've been a terrific stock for us. We've just sold it, for valuation reasons. And then from an operating income growth perspective, again, a few of our holdings there, being Amber and Icon, and a few of the other ones we follow closely, but are holding back for valuation reasons. So again, when you run these companies over the quality hurdles, you see there's a very broad opportunity set. So then comes the question, why would you make an allocation to global small and mid caps now? Like, what's the really interesting point about investing in these things now? And this chart really just takes some of those sub-asset classes we talked about earlier and maps them in terms of their PE on the left versus their long-term EPS growth. And the grey box on the right-hand side, that represents MSCI World Mid Cap. And the point we'd make there that even though the PE is at a little bit of a premium to the broader market, you are getting so much more growth. You're getting so much more growth than other subsets. You're not getting quite as much growth as small cap stocks, but what you get more liquidity. And that's why you step back a little bit. So there is a really good opportunity now from a valuation perspective to pick up these names. And this comes out in the next couple of slides. So this chart looks at global small mid-cap equities on the far right-hand side. So this is looking at the PE of the asset class versus others. So again, at 17.2 times, It's at a very modest premium to the MSCI World Index. It's at a pretty big discount to growth, so large cap growth, about 3 PE points. And yes, it's a bit more expensive than emerging markets, but that's not to be, that's not no huge surprise because you're comparing apples and oranges, quite frankly. When we look at the PE versus their 10-year average, so this is also really important, you need to have the context of where various sleeves within global equities are trading versus long-term averages. Again, they are only trading at a 3.6% premium to their 10-year average. So despite the really strong performance in the asset class, very, very little of that performance has come from PE expansion. The same cannot be said for MSCI World Growth Index, where you've seen huge PE expansion. Yes, there's been good underlying growth, but they're much more vulnerable to a PE derating scenario going into a tougher environment. MSCI, the Aussie Small Cap Index, is in a very, very similar boat, so huge PE expansion has driven performance, probably arguably leaves it a little bit more vulnerable than some other sub-asset classes. So in summary, if I was to really wrap up the argument for an allocation of global SMID, it is beneficial for your risk-adjusted returns. That's the first point. The fundamentals are really, really strong, especially when you apply a quality approach to the asset class. The valuations are attractive. Most portfolios have got no exposure, which to me is crazy. Investors need to be making allocations now. So you should be making allocation to SMID now, in our opinion. It's very, very compelling. And then when you think about how would I fund it, well, you can fund it by taking the profit in large cap growth for the reasons I explained, emerging markets, which have a habit of keeping everyone up at night, and then also Aussie small caps, again, where people have made a lot of money in recent times. So that's really the summary, and that's it. So I might hand back to Xanthi now.
Great, thanks very much, Ned. So I'd just like to take you through how you can now actually access our particular strategy. So for Australian retail investors, we offer 2 funds. Firstly, the Bell Global Equities Fund, which is a diversified portfolio of around 100 quality stocks across the market cap spectrum. So it includes quality, large and mega cap names, plus small and mid caps. That fund includes about 45% exposure to SMID. Alternatively, for investors who want more discrete or specific focus or exposure to global SMID, we offer the Bell Global Emerging Companies Fund, and that's a more concentrated portfolio of around 45 to 50 stocks, and it's just a focus on global small and mid caps. So both funds are rated by Lonsec and Zenith and are available on a number of investment platforms and also via ASX mFunds. Pleasing to note that the recent performance of both funds has been very strong, outperforming not only the benchmark but many of our peers. And we are of the belief that the current market environment is quite conducive to our investment style, and we're confident that we're continue to be presented with excellent opportunities in this space going forward. So we'd love to speak with you about it in more detail, so please let me know if you have any questions, or contact us or our new distribution partner, Channel Capital. We've probably got time for 1 or 2 very quick questions before we wrap up finally. I have a question here. How do you think SMID stocks will perform in an economic downturn?
Yeah, thanks for the question. It's a really good question. We get that a lot. We actually think they will perform quite well in an economic downturn because at the moment, if we think about where we are right now, we've been going through a period in the last 12 months of economic deceleration in various parts of the world, but particularly in Europe. And to a large degree, that is now factored into the valuations we believe. The PEs are now reflecting a more subdued growth outlook. One of the, and I think, the chart I brought up earlier showing how the asset class performs in negative market conditions, I think really backs up my view that you tend to find stronger franchises in the global mid-cap cohort. And because of that, the earnings as a whole tend to hold up a bit better than would be the case with, for example, some of those other growth sleeves like emerging markets. So we think that they will actually hold up a little bit better than most people would expect.
Great, thanks, Ned. Probably time for one more. From a valuation perspective, why is the SMID segment appealing now?
Yeah, another good question. So, as I mentioned before, the valuation of the subset, of the small mid-cap subset, has been, it's really stagnated the last couple of years. It's now trading on a P of a bit under 17 times, which is, it's as of now, it's pretty much in line with its 5-year average. Slightly above the 10-year average. So that's against a backdrop of other parts of the market that have seen huge PE expansion. And obviously the sector has lagged somewhat. So if you think about it, you're paying effectively, you're getting an earnings yield north of 6% in a market where interest rates are obviously incredibly low. So I think there is a strong valuation underpinning for the asset class. Earnings expectations are, I'd say, somewhat subdued, and that's to be expected. But the point is the downside, to some degree, the downside risk in earnings estimates for mid caps, that's already played out. I don't think there's a lot more earnings risk to come. So there is at least some sort of argument that if you start to see a little bit of a turnaround, a little bit of an uptick in economic activity next year, there is the possibility that you'll see some valuation expansion into the new year, and that's really what we would probably expect to see happen.
Great. Okay, thank you so much, Ned. I think we've got to leave it there. It's just gone after 3 o'clock. So thank you all very much for dialing in and listening to the webinar. We appreciate your interest. If you have any more questions or would like any more information, then please feel free to get in contact with us. We will also be making this available on the website if you'd like to listen again or forward on to any of your peers. So thanks very much again, everyone, and have a good afternoon.